Mute.
Good afternoon, everyone, and welcome to the ProNexus Lease Counting webinar. For sound check purposes, please click the raise hand button at the bottom of your screen if you can hear me okay. Can everyone hear me okay?
Yep, I saw a couple raised hands, Raphael.
Excellent. All right, by way of introduction, my name is Raphael Vidal. I'm one of the founding partners of ProNexus and lead partner for Leases. With me, I have Dan Hawthorne and Mike Knapp, both part of our lease accounting advisory and implementation team. We have our email addresses on this slide, so feel free to jot those down now in the event you would like to reach out to us individually after the presentation. Before we begin, we do have a few housekeeping items to address. You will be muted for the duration of this presentation. So if you have any questions, please use the Q&A feature at the bottom of the screen. We'll answer your questions at the end of the session, and a recorded version of the webinar will also be sent to all the participants. Lastly, we will have a few polling questions throughout the presentation. We ask that you take a few seconds to answer those questions as they come through. For those of you on the call who aren't familiar with ProNexus, ProNexus was founded by two Big Four CPAs from PricewaterhouseCoopers and Deloitte & Touche. The entire leadership team are either CPAs and or former controllers and CFOs. We operate the firm very much like a CPA firm. However, we only perform non-attest services. We have 5 core services, including consulting, project work, outsourced accounting services, interim and loan staff services. If you'd like to learn more, please feel free to visit our website. On the home page in the upper right-hand corner is a link to our case studies, which really gives you a good idea of how we help clients. In terms of our experience with leases for the last 2+ years, we've been helping companies implement the new lease accounting standard. We've developed a significant number of IP and tools to streamline the process. In addition, we've invested into lease accounting software to help clients accelerate their implementation. And we've worked with clients that have as low as 10 to 1,000 leases. As you can see, we have an action-packed agenda for you this afternoon. Agenda items 1 through 11 will provide you an overview of the new lease accounting standard. Items 12 through 18 will provide you a roadmap on getting started, including keys to success and pitfalls to avoid. Items 19 will provide you software solutions to consider. And finally, we'll wrap up with some recommendations, how we can help, and some Q&A. Before we begin, we're going to give you 15 seconds to answer our first polling question. Excellent. Thank you. Okay. ASC 842 is a challenge. As illustrated in the bar graph, nearly half of executives are concerned about the implementation. It's also pervasive. It affects any client that follows GAAP, IFRS, or GASB 87 and has basic operating leases. With the amount of data required to be abstracted and complicated calculations, the implementation is complex, especially utilizing spreadsheets. Also, with other recent competing requirements such as RevRec, it's been a lower priority. And we're finding that there's more work involved implementing the new lease accounting standard than there was with RevRec. So what is the new lease standard? Well, the new standard is intended to account for all lease obligations on the financial statements. The end goal is to provide more transparency around leasing contracts. Operating leases will now be treated as assets and liabilities. As many of you may have heard, the FASB has delayed the date to comply for another year. So for non-public organizations, this will move the requirement to the fiscal year starting after December 15, 2021. And for public nonprofit entities, this moves the requirement to fiscal year starting after December 15, 2020. We've been cautioning our clients that more time won't lessen the workload that the rules require. Our biggest fear with this is that companies will just put this off for another year and kind of be in the same position. So having said that, some of our privately held and not-for-profit clients have already started their implementation projects. There is no penalty to adopt early, and we recommend those companies continue with the implementation efforts at a less rigorous pace. For those of you that have not adopted, at a minimum, we recommend to get started now with 1 of 2 options, or a combination thereof. The first is to complete the planning, scoping, and assessment phases of the implementation. There's not a lot of work involved there, and it will really provide you some visibility to what's ahead while identifying the high-risk areas and planning accordingly to meet the compliance deadlines. The second option would be to purchase lease accounting software, abstract the data elements from your existing leases, and upload the data into the software. This will really allow you to maintain the lease data in a central repository, estimate what your day one ROU calculations may look like, and allow for a quick and seamless implementation when the time comes. And this would be no different than having, for example, a fixed asset software for your fixed assets. Now, the lease accounting software, it is cost effective and can be purchased through our firm. For example, if you have 10 leases, it would cost you no more than $1,500 per year for a subscription license. For that price, the solution is highly recommended over the alternative of using cumbersome Excel spreadsheets. So to qualify as a lease under the new standard, there's three things. It must be a physical asset. You must have the right to control or use the asset, and the asset must be explicitly or implicitly identified. Understanding the new rules. So at a high level, the end goal is to provide more transparency around leasing contracts. Operating leases will now be treated as assets and liabilities. Some procurement contracts may contain embedded leases, for example, raw material procurement contracts or warehousing agreements. And I'll turn it over to Dan to provide some further insight on that.
Thanks, Raphael. AFC 842 actually requires you to examine all contracts to determine whether each contract is or contains a lease. A contract has an embedded lease if there is an identifiable asset and the lessee has control of the asset and receives substantially all of the economic benefit. One of our clients had warehousing contracts that did not qualify as operating leases under 840, but did qualify as operating leases under 842. The facts were the warehouse was the identified asset. The lessor did not have the right to service other customers without the permission of the lessee, therefore control. The lessee has 90% or more of the capacity of the warehouse, therefore receives substantially all the economic benefit. This service contract now qualifies as an operating lease under 842, and an asset and a liability had to be recorded. We also have a medical client with agreements to purchase a minimum amount of supplies and in turn receives the related equipment needed to use those supplies at no cost. For example, they have a procurement agreement to purchase leg compression sleeves and accessories for hospital inpatients to prevent blood clots. The minimum commitment to purchase the supplies includes the related compression machines at no cost for the life of the contract, and these machines are to be returned to the provider at the end of the contract. On the surface, this looks like a procurement contract for the purchase of medical supplies. But this client now needs to look closer at this contract to determine whether the compression machines would meet the definition of an ROU asset and be considered an embedded lease, which it did.
All right, thanks, Dan. So, thanks, Dan. So, as you can imagine, there's now additional visibility provided to the leases, which will increase the level of scrutiny from your auditors as well. So, expect to spend some more time testing the completeness and accuracy of your lease data. So what is the impact of the new lease standard? Well, with leases transitioning to the balance sheet, CFOs need to consider the impact on your financial performance metrics, such as working capital, the executive compensation and performance plans, and then compliance with debt covenants and borrowing ability as well. Clients are concerned about potentially violating bank loan covenants under 842, so we highly recommend getting a handle on the potential impact and starting conversations with your bank as early as possible. Additionally, companies will need to address how much effort will be required to comply and what the administration burden may be for the accounting and other departments such as IT. As a reminder, if you guys have any questions, please use the Q&A feature at the bottom of the screen. I'm going to turn it over to Mike now to discuss the differences between 842 and 840.
Thanks, Raf. As you probably know, ASC 840 had identified two types of leases, operating and capital leases. Capital leases have been treated as long-term assets and are capitalized to the balance sheet, while operating leases are recognized as period expenses. These haven't been capitalized to the balance sheet, but balance sheet adjustments may be needed to recognize the expense on a straight line basis. On this slide, we'll look at some of the new aspects of ASC 842 and how they compare to the old standard. As we've already discussed, the new standard provides a little more clarity on the scope and definition of what qualifies as a lease. But basically, a lease is an identified asset that you control for a specified period of time. US GAAP and IFRS have both come out with new standards. While each group's original intent was to better align the two, they haven't been fully aligned in all areas and will require separate accounting. Today's presentation will be focused on US GAAP. If you do follow IFRS or want additional information, we'd be happy to schedule some time to discuss this with you. Under the new standard, accounting for the lessor is relatively unchanged. There are some new classifications, criteria, and modifications that leverage certain guidance in the new RevRec standards, but the new lessor accounting remains similar to the existing standard. Because of this, today's presentation will be focused around the lessee. If you are a lessor, we'd be happy to schedule some time to discuss those requirements with you. Under the new standard, treatment of capital leases, which are now called finance leases, also remains relatively unchanged. The big change in the new standard is with operating leases, which must now be capitalized on the balance sheet. We'll talk about the steps in more detail, but here's a quick overview, which covers items 5 and 6 on the current slide. A right-of-use liability is first recorded and is calculated as the present value of all lease payments. Basically, you're creating a loan amortization schedule. And a right-of-use asset is then calculated to be equal to the initial right-of-use liability plus or minus any adjustments, such as upfront payments or existing ASC 840 liabilities. Then in subsequent months, adjustments will be made to these initial balances. The liability will be adjusted like a normal loan amortization based on cash payments less a calculated interest expense. A straight line expense will be determined based on total lease payments divided by the number of periods. And the asset amortization will be equal to this straight line expense less that current period interest expense. In the coming slides, we'll also discuss some required changes to balance sheet, income statement, and cash flow presentation, as well as significant changes with the required disclosures. And the new standard introduces a few policy elections and practical expedients that you can choose to elect. In some cases, these can help ease the burden of implementation. In other cases, they become more of a best practices type of election. The following slides will cover items 5 to 9 in more detail, and Dan will start to discuss the initial recognition and measurement.
Thanks, Mike. As Mike said, this slide talks about the recognition and measurement of leases. Raphael, I think we need to go to the next slide. Thanks. For the balance sheet, the recognition and measurement of new operating lease and finance leases, once you have implemented the standard, which we refer to as day one, for both the ROU asset and liability will be the present value of the lease payments using the discount rate. The assets will be adjusted for any prepayments made or incentives received. For existing operating leases, before day one of implementation, the ROU asset and liability will be the present value of the remaining lease payments. The asset will then be adjusted for any other 840 balances related to the lease, for example, outstanding prepaids or deferred rents. For existing capital leases, the ROU liability will increase based on the interest method using the discount rate and will be reduced by the payments made. The ROU asset will generally amortize over a straight line basis, similar to 840 amortization schedule. Expenses on the income statement generally will be front loaded for finance leases and straight line for operating leases. Now to the balance sheet presentation. For the balance sheet presentation, the ROU assets can be presented either separately or together with other assets. If they are presented together with other assets, disclosure of the line items that include the ROU assets and their amounts must be noted. Finance lease ROU assets must be presented separately from operating leases and ROU assets. These assets are subject to the same classification as other non-financial assets. The ROU liability can be presented either separately together as well with other liabilities. If presented together with other liabilities, disclose the line items that include the lease liabilities and their amounts. Finance lease liabilities must be presented separately from operating lease liabilities. Both these liabilities are subject to current and non-current classification similar to other financial liabilities. For leases dominated in a foreign currency where remeasurement to the lessee's functional currency is required, want to note to keep in mind that the ROU asset is a non-monetary asset and will be measured at the historical cost and is not affected by subsequent changes to the exchange rates. On the other hand, the lease liability is a monetary liability and will be remeasured at the period end exchange rates. Exchanges in lease liabilities due to changes in exchange rates will be recognized in profit and loss.
As you may have noticed, a lot of the new accounting treatment and disclosure requirements have been differentiated between operating and finance leases. Under the new standard, expenses related to finance leases will have two components, interest and amortization. This is consistent with the current capital lease treatment. The income statement presentation will need to be consistent with how the company records similar expenses. A company's interest expense will be determined based on the related loan amortization schedule, and this should be included with other interest expense. The right-of-use asset will be amortized on a straight-line basis, and this expense is included with a company's other depreciation and amortization. Because the amortization expense is fixed and interest expense decreases over time, this treatment for finance leases results in more expense in earlier years and less in later years. For operating leases, the lease expense will be presented as a single operating expense in income from continuing operations. As we talked about previously, the lease expense will be recognized on a straight-line basis over the term of the lease. The lease cost will be recorded as a single line item without any differentiation between the interest and amortization components. Moving on to the statement of cash flows, payments made for finance leases will again be broken out into two components. The principal portion of the lease liability will be recorded with financing activities, while the interest portion will be recorded with operating activities. For operating leases, it's another one-line disclosure. The entire lease payment will be recorded with operating activities. Any short-term or variable lease payments will also be disclosed as a single line item use of operating funds. The new standard also requires non-cash disclosures to reflect any right-of-use assets obtained in exchange for the new lease liabilities. In addition to the non-cash disclosures, there are certain required qualitative and quantitative disclosures, and Dan will now discuss the qualitative requirements.
Thanks, Mike. The qualitative disclosure objective is to enable the financial statement users to assess the amount, timing, and the uncertainty of cash flows arising from leases. This disclosure should include information about the nature of leases in the portfolio, basis, terms, and conditions on which variable lease payments are determined, extensions, terminations, and purchase options, options that are and aren't recognized as part of the ROU asset and lease liabilities, restrictions or covenants imposed by leases, significant assumptions and judgments made, for information about leases that have not yet commenced, but that create significant rights and obligations for the lessee, lease transactions between related parties, and any other significant information you feel important for the financial statement user to have. Now, Mike will discuss the quantitative disclosures.
Thanks, Dan. The table on the screen provides an example of what your new footnote disclosure may look like. For each period presented in the financial statements, a lessee must disclose the amounts relating to the lessee's total lease cost and the cash flows arising from lease transactions, separated by finance and operating leases. This slide is presented almost exactly as it's defined in ASC 842, presenting the 10 required elements from the standard. As we discussed previously, your finance lease costs will consist of two components, amortization and interest, while your operating lease costs will be presented as a single amount. A quick review of this table shows that we also have to disclose any short-term or variable lease costs, any sublease income, gains or losses on any sale and leaseback transactions, operating and financing cash flows, the right-of-use assets obtained in exchange for the new lease liabilities, weighted average lease terms, and weighted average discount rates. And as a final recommendation, you will still want to disclose your future obligations for your commitments and contingencies. I'll now turn it back to Raphael so that he can summarize what we've covered so far.
Yeah, thanks, Mike. So in these previous slides, we covered a lot of material, including the comparisons between 840 and 842, the initial calculations and schedules, the balance sheet, income statement, and cash flow presentation, as well as disclosure. So as a reminder, if you have any questions, please use the Q&A feature at the bottom. We're going to give you a few seconds now to use that feature and ask some questions while I turn it over to Dan to discuss the policy election. So maybe Dan will give it about 5 seconds, and then we can go ahead and start the next slide.
Okay, thanks. Okay, so let's go over the policy elections. The new standard allows for policy elections to be made for compliance as of day one. Keep in mind that once these have been made, they are not to be changed. The policies can differ by asset class, real estate versus equipment. We are not going to discuss all of them in detail, but provide a few examples. The election can be made not to include any leases with terms of 12 months or less in your ROU calculations. You can choose not to show 842 comparative periods, only the current period. These are a couple examples of easy choices to make. Now Mike will cover one of the more complicated policy elections.
Thanks, Dan. When I first heard about the new lease standard, I thought it would be pretty straightforward. After all, we're just adding an asset and liability to the balance sheet, right? However, after reading through the standard plus additional literature, I discovered that it was more complex than I would have expected, with some fairly technical guidance. For example, the concept of lease and non-lease components contains some of this guidance. Now, after determining that a contract contains a lease, an entity must identify any separate lease components within the contract. An entity shall consider the right to use an underlying asset to be a separate lease component, that is, separate from any other lease components of the contract. This happens if both of the following criteria are met. 1, the lessee can benefit from the right of use either on its own or together with other resources that are readily available to the lessee. And 2, the right of use is neither highly dependent on nor highly interrelated with other rights to use the underlying assets in the contract. Then, consideration in the contract must be allocated to each separate lease component and non-lease component. Now, components of a contract include only those items or activities that transfer a good or service to the lessee. But administrative tasks and reimbursement or payments of lessor's costs are not components of a contract and do not receive an allocation of the consideration in the contract. To me, this part of the standard got to be a little bit confusing, and I had to reread it several times. But basically, it says that a contract may contain certain items that are considered lease components, certain items that are considered non-lease components, and certain items that are neither. And there's a proper way to handle each. Going through a quick example might help to explain this. With an office lease, you might be required to pay for the office space, common area maintenance costs, real estate taxes, and insurance. In this type of lease, the office space and common area maintenance are considered components because they are either an asset or a service. The office space is a lease component since it's the identified asset, and the common area maintenance is a non-lease component because this is a service. And use of the office space is not impacted by whether or not this service is performed. For example, if the landlord doesn't cut the grass or clean, the tenant can still use the office space. However, taxes and insurance are not components of the lease, since these are neither a good nor a service. They are the lessor's cost obligations, and therefore the cost for taxes and insurance must now be allocated between any lease and non-lease components. It's the costs related to the lease components that are then used to calculate the right of use asset, and the common area maintenance costs would be ignored for this calculation. Now, this can be a pretty significant exercise with a lot of effort for a lessee to go through for each lease, especially if they have hundreds of such leases. Because of this new standard allows a practical expedient to ease this burden. Under this expedient, you can elect to combine any lease and non-lease components and forego these calculations. This will ultimately increase your right of use asset and liability calculations, but it can greatly simplify the process. Now I'll turn it back to Raphael to discuss our next steps.
I was on mute there. Thanks, Mike. Wow, that was a lot of material. The good news is we still have the same number of participants on the call that we started with. So nice job there, Mike and Dan. All right, so the next topic is going to be what to expect from your audit firm. Many clients have asked us what to expect from their auditors. The answer, really varies. But the reality is most of the CPA firms, excluding the top 10 or so CPA firms, are trying to figure out, trying to figure this out themselves. On this slide, there is a typical audit roadmap that is being used by the big four CPA firms. ProNexus has adopted a three-phased approach to accommodate this roadmap. And this approach really helps our clients prepare the required documentation for auditors to review so they can gain comfort in the overall calculations. So with that, I'll turn it over to Mike to walk through the roadmap.
Great, thanks, Ralph. When implementing the new lease standard, we definitely think that a company should favor a process that aligns with their current business needs. In addition, we think that the company should also remember that their auditors are going to audit their implementation process, its related assumptions, and its calculations. For our clients, we've planned our scope of work to match closely with this audit roadmap, knowing that they would need to provide their auditors with this type of information. In whatever approach you take for your implementation, we think that it's good for you to keep this roadmap in mind. At ProNexus, we've developed a three-phased approach to our implementation process that includes planning and scoping, assessment, and execution. During the first two phases, we address many of the same questions and use a similar approach to the first four steps of the audit roadmap, where 1, we obtain an understanding, 2, assess risks, 3, develop a preliminary strategy, and 4, test controls. For example, we start with a lease assessment questionnaire that we review with each of the key stakeholders involved in a client's leasing process. This questionnaire provides us with such information as the client's current procedures, any controls that are in place, their current knowledge of the leasing standards, and their current compliance with ASC 840. Then this questionnaire, coupled with other information we receive, helps us to gain a preliminary understanding of the overall leasing environment. From this, we will make an initial assessment of any current risks or deficiencies and prepare our work plan. We will also review the client's general ledger to test whether our understanding matches with their actual process. In a similar way, our execution phase also aligns with the later steps of this roadmap, and Dan will now discuss these steps.
Thanks, Mike. Steps 5 through 8, auditing the prospective period. You will have to perform and document all financial support for implementing 842 for substantive testing. This will include, but not be limited to, review of all contracts to determine if they qualify as 842 leases, operating or finance. Document all data points needed for calculation of the ROU assets and liabilities, rent expense types, and test for completeness. Do we have all our leases accounted for? Determine the discount rates to be used to calculate the present value of the payment streams. How are these rates going to affect the present value of the lease payments, and how are we going to determine whether the auditors are going to approve the discount rates that we've chosen? Develop the journal entry and support to recognize the ROU asset and liability to be booked on day 1. Develop and document the transition process to record the amortization and rent expense for day 2 and beyond. This will include not only the day 1 leases at implementation, but also new leases, impairments, remeasurements, exercising options, amendments, the list goes on. To accomplish this, you will need to have an understanding of significant accounts and classes of transactions. The processes and controls that you employ to address the completeness of your population of leases. The completeness and accuracy of the lease data used in calculating the transition adjustments, the calculation of the transition adjustments, the design and establishment of new accounting policies and procedures to address the accounting and disclosure requirements under ASC 842 and or IFRS 16. Finally, completing the 842 audit of procedures, accuracy, and completeness of the new disclosure as required.
Great, thanks, Dan. So everyone, as a reminder, if you have any questions, please use the Q&A feature at the bottom. I know we're covering a lot of material here in a short period of time. All right, so on this slide, there are 6 key roadmap steps to get started. First, you'll need to understand the new rules and what the risks are. Secondly, you'll need to perform an assessment and understand the implementation challenges and risks. Next, you'll need to staff the project team, which includes identifying a sponsor, a project manager, and assigning a cross-functional team. You'll also need to reevaluate the maturity of your current lease program. For example, what systems, processes, and controls are in place. Then you'll need to define the project scope and strategy. For example, are you just looking to comply, or do you want to implement best in class? And lastly, you'll need to define the budget and the timeframes. After completing those 6 steps, you should be in a pretty good position to get started with the implementation. So the 5 keys to success for lease accounting projects that we have found to be best practices is: first, you want to build that cross-functional project team. Other than accounting, you're going to want input from other teams such as legal, procurement, IT, real estate, and tax, just to mention a few. Second is to pinpoint the issues with the technical accounting piece. For example, the embedded leases and the equipment leases are are consistently reported to be more challenging than the others. The third key is collecting the data, which will be the hardest part, and we'll cover that piece in a later slide. Next is choosing your software package carefully. Again, we don't recommend using Excel. It's cumbersome and prone to errors. If you partner with a firm like ours, we have invested into lease accounting software. It's cost effective, and you can use it to simply comply with the new standard. Our clients use our software for free during the implementation to get them in compliance on day one, and then for day 2 and beyond, you can choose to buy the software. We can help you select and implement other software that might meet your requirements better. We'll be discussing software further on another slide. Lastly, you'll need to set up a model for day 2 compliance and beyond. Performing the accounting on an ongoing basis will really require processes that keep the lease data accurate, complete, and up to date. You'll also need to establish policies and controls for lease management. For day 2 compliance and beyond, you can also partner with a firm like ours and outsource the maintenance of the software and recurring compliance if you choose. When we look at some of the most common mistakes that we've seen, those include 1, ignoring non-real estate leases, and 2, internal controls and post-implementation. If you're a publicly traded company, it's obviously complying with Sarbanes-Oxley. The data for non-real estate leases will be much harder to collect. Most companies don't have a centralized group nor an enterprise application to track those. Post-implementation success requires the development of a repeatable process to consistently maintain accurate and complete lease records to comply on day 2 and beyond. It'll also require automating some of those processes for tracking the changes to the leases. Lastly, you'll need to have some systems, processes, and controls in place that will stand up very easily to an audit. So before we walk through the workflow plan, we want to cover what companies typically lease and where these leases can be found within an organization. In addition to your real estate leases, here you'll find some of your typical non-real estate leases. For example, your IT and data center equipment, vehicles, and manufacturing equipment. As mentioned previously, some of these non-real estate leases could be embedded in procurement contracts. This slide illustrates the 11 places to look for leases, which includes anywhere from accounts payable to IT to legal. And in some cases, our clients couldn't find some leases and we had to go to the lessors because there's so many departments involved, it's important to build a cross-functional team for this project. Before we begin the workflow plan, we're going to give you 15 seconds right now to answer our second polling question. Okay, wonderful. Thank you for that. Okay, so this slide represents a typical workflow plan that we use when implementing the new standard, and this aligns with what to expect from your audit firm that we discussed previously. One of your first tasks will be to perform an assessment and obtain an understanding of the current state lease processes and the relevant procedures, data, and systems involved. This assessment will allow you to determine the size and scope of the overall work effort. For lease accounting projects, the complexity will not necessarily correlate with the size of a client's company or their annual revenues. Instead, it's really a function of the complexity of the client's lease portfolio and the maturity or immaturity of the related processes. As mentioned previously, we have a survey or like a questionnaire that we use as a starting point. We also speak with the lease stakeholders. During this process, there's an opportunity there to identify savings by not only solving their lease accounting problem, but by enabling better lease administration as well. The next task is to perform an enterprise-wide lease census. Our goal here is to build a master list of leases, including embedded leases. We just reviewed some of the assets companies typically lease and where to look for them. We have a checklist that we go through to ensure completeness, and we document the testing performed so this can be provided to our clients' auditors as well. As we perform our review, there are several places to look and questions to ask to build the census. Some of those questions we ask to build the census occurs during the assessment phase. And key questions includes, who negotiates the leases, who manages the lease assets, and who reports on the leases, just to name a few. Another task in the workflow plan is to define the project strategy. On one hand, your leasing program may be mature and you decide the strategy is just to comply. On the other hand, you may want to do more than just comply. There may be significant savings opportunities and you decide that the strategy is really to just transform the entire process. The fourth step here is designing the future state. As you're performing the work, the end goal is to design the future state, which applies to day 2 and beyond compliance. Here, you want to design business processes and systems for the future. The fifth task is to determine how long the project will take, the resources required, and estimating the budget. Number 6 and 7 on this slide, which is collecting your lease accounting data coupled with the contract review, I would say is the most time-consuming aspect of the project. We have a list of 100 data elements that we recommend clients abstract from their leases. With some of our clients that are implementing a more robust program, we've seen as many as 180 data elements collected. Let's skip ahead to slide 24 for a minute. Starting from, oh, I went ahead too far. Here we go. Starting from the lease census, this schedule summarizes the different activities required to collect your lease accounting data. The information is split between 2 phases, the planning and analysis phase and the data aggregation and upload phase. Let's go back to the workflow plan to discuss the contract review process. All right, in terms of labor effort, on average, it takes 2 to 4 hours per lease on the low end to 6 to 8 hours on the high end to review contracts. I'll also tell you that if you have people that don't have much experience reviewing contracts and understanding the legal language, it could take those folks up to twice the amount of time than experienced professionals. For example, Mike, who's on this call and is a senior manager on our team, on average is 1.5 times faster getting through some of these contracts than some of our seniors are. The 8th step here is the policy elections, which we covered that in detail on a previous slide. But I would add on that in some cases, clients do ask us to prepare pro forma analysis to support those policy election decisions. The last step here is to select a software vendor. So let's go to slide 25 to cover that section. All right, so as previously mentioned, we believe using Excel to manage the ongoing compliance will be difficult and will increase your risk. We would highly recommend considering software solutions. As mentioned previously, we have a lease accounting software on the cloud that we use to implement the new standard. The software is designed to comply with the new standard by providing you the necessary journal entries, amortization schedules, and related footnotes to include in your financial statement. This slide illustrates the essential innovative features the software offers. If you look on the left-hand column, you'll see the essential features. It complies with both IFRS, FASB, and recently it was modified to comply with GASB as well if you're a governmental entity. We are in the, it has the ability to attach documents, and you can access this anywhere and anytime. If you look at the right-hand column, the innovative features it has includes the policy election templates. It has a lease term and classification wizard and automated quantitative footnote disclosures as well. If you're interested in the software, we will be performing our next lease software demo on September 21st. So we're going to give you 15 seconds now to answer our third and final polling question. Excellent. Thank you, everyone. Okay. So we've made some recommendations throughout this presentation. However, this slide really summarizes them all in one location. Our first recommendation is to make good policy elections. Next is to get an early start on understanding the impact on the banking relationships and checking in with your banks. The third is to allow sufficient time to implement. Next, choose a software solution in place of spreadsheets. Next, partner with a firm to provide advice, supplement your team, or even outsource all of this or a portion of it. Lastly, take action as soon as possible. It's important to assess the size and complexity of your lease portfolio, the strengths and current centralization of your process for leases, and the scope of your implementation process as well. And with any standard accounting standard change, it's important to get an early handle on it, get the experts involved when needed to provide the best and most prudent advice. The new lease standard is subjective and open to interpretation, and having the supporting documentation for the policy elections and the confidence in the calculations will make for a much smoother implementation. If you feel like you're behind, or you want an independent, objective look to confirm that you're on track with this implementation, or maybe you have some gaps you'd like to address, ProNexus can help you. We've been working on this for the last 2+ years with publicly traded clients, and our privately held and not-for-profit clients have started recently. We've invested in the software and developed IP and tools that can help you accelerate your implementation as well. So as you can see on the screen, we have the assessments, we have the lease summary abstracts, we have the pre and post adoption validation checklist. We also have a decision tree, the contract review checklist, just to name a few. If you're looking to partner with a firm, ProNexus can help you in a variety of ways. We can help you understand the new rules. We can help you with roadmap development, planning and scoping, doing an assessment or gap analysis for that matter, software selection as well. I think we talked about that earlier. If you have any issues with people, processes, or controls, that's another area. Project support and execution. In some cases, and some clients, some larger clients took some of their own people from their day-to-day jobs and asked us to backfill the day-to-day jobs. So we're really flexible on anything that you may need. So how you structure the resources, tools, and expertise to implement the new standard can vary. We can sit down with you and discuss your requirements and the options available to your organization. Okay, so we're looking at some of the questions that have been submitted. Thank you for submitting those questions. We've picked a few to respond to today. Our next webinar will be the software demo, which is on September 24th, so we hope you can join us for that. We'll send a link for registration after this webinar. And we'll take the remaining time to answer some questions.
Okay, Ralph, I got the first one. Based on the delay of implementing the lease accounting standard, what can we do now?
Okay, well, that's a good question. So for those companies that have started implementing, we recommend continuing the implementation efforts at a less rigorous pace. For those that have not adopted, at a minimum, we recommend to get started now with one of two options or a combination thereof. The first option would be to complete the planning, scoping, and assessment phases of the implementation. There's not a lot of work involved there, and it'll really provide you visibility to what's ahead while identifying the high-risk areas and planning accordingly to meet those compliance deadlines. Typically, when we do this ourselves, we can get that work done, typical average client, in less than about 100 hours. The second option is to purchase the lease software, abstract the data elements from the existing leases, and upload the data into the software. That will allow companies to maintain the lease data in a central repository, estimate what your day one ROU calculations may look like, and allow for a quick and seamless implementation when the time does come. I know there's some attendees on this call that have already implemented day one and are in day two and beyond compliance. So there's an opportunity there to essentially optimize and automate some of the processes that you may have currently today. So for example, you may have decided just to comply with day one, and now you're looking to transform how lease management is handled at your organization. All right, Dan, I've got a question here. Maybe you can handle this one. All right, so could you provide more details on the reporting tool included in the ProNexus lease accounting software?
Sure, Ralph. The reports that are available include, as far as the accounting that you need to have done to calculate your ROU asset and liability and have that support, are the journal entries, amortization schedules, the ASC 842 or IFRS 16 footnote disclosure schedule that we saw in the presentation. And you can also run a report that will show you all the lease data points, qualitative and quantitative, that you've entered into the system by your lease, by each individual lease. All these reports can be downloaded in Excel format. You have the option to select it by the different fields. For example, you could select one lease, you could select many leases, you can select them by companies, you could select it by asset types, etc. And you can save these selections into a drop-down report capability. So you can just select that report name and all these leases would come up. They also have in the system an audit trail that tracks all changes and all access that was given to the different users and what they have changed. Also, the software has a workflow approval where whoever enters the leases can send an email to someone to approve that, and that approver can go in there and approve that lease after review and mark it as complete, and then you can start running your reports and using it.
Great, great. I've got one final question here, Dan or Mike, if you want to answer this one. Let's see. Do you recommend any lease accounting software system?
Hi, Raf. This is Mike. I think I can take that one. There are a number of options for lease accounting software, and we've actually worked with several of them. But it's hard for us to recommend any one software because every company is different, and you really need to select the software that works with your business model and addresses your business needs. But we can help our clients assess and select any lease accounting system that is available in the marketplace. Now, some of the packages out there are pretty costly. They have a lot of bells and whistles, and they'll provide lease administration and asset management functions in addition to the basic lease accounting calculations. Now, often it's those larger companies with real estate, procurement, legal departments that want the more robust lease administrative systems. But these systems can be overkill for some of the small to mid-sized companies. But there are other systems like the ProNexus lease software that are more cost effective and are designed to comply with the new standards. These systems primarily collect key information from the lease agreements, and they'll help provide the information necessary for your 842 reporting. Our software system stores all the lease supporting documentation and provides a lot of useful reports, which gives all the necessary information, like Dan talked about, to perform those 842 calculations, as well as some of the qualitative information that you'll need. It also provides a really helpful footnote disclosure report, similar to that one we looked at earlier in the presentation. We use the system to prepare our calculations while we're going through the implementation process with a client. And then at the end of the implementation, the client has the option to continue using our software or move the data to another system. If they think a different software may better address their needs, we have the tools that can help them to assess those options. And as Dan and Raphael had both said, we have a software demo coming up September 21st if you'd like to see more on our system.
No, thanks, Mike. That was great. It looks like our time is up, and we're just right on. We're right on time. So I want to thank everyone for participating today, joining us. And I want to thank the panelists for all their hard work and preparation. And as Mike mentioned, our next demo or webinar is a software demo, which we'll be doing on Monday, September 21st. So thanks again, and enjoy the rest of your week.